And welcome to the TSP Weekly Podcast, the only place you can find two guys talking about thrift savings plan. Pretty sure there might be one guy out there talking about it. This is the only place you're going to find two guys.
That's true. That is probably true.
Yeah. Well, to be fair, it's mostly Jerry talking about it, but every once in a while I pipe in.
Nah, it's all good. Definitely makes it more interesting for people to listen to it than just listening to me blabber about the stock market.
See, I don't know. Like the few times that we've gotten comments about that, I do recall a couple that said, I wish Conan would talk less. And I'm like, I barely talk.
Yeah. You kind of do. You don't talk that much.
No, I don't. But when I do, it's usually opinionated.
Yeah, but that's, I mean, I tend to talk about the more technical stuff, and it's definitely good having somebody interject with thoughts about how people would think about this stuff other than me.
Well, that was always the point. Like when we first started this podcast, it's been almost 5 years now. The whole point of me being on there was to be the idiot in the room. Right. And it's like, now over the last 5 years, I've learned a lot and I can hold my own when it comes to discussions on this. But the idea was I was supposed to be the dummy in the room. So that's usually what I put in the comments. Somebody says that. I'm like, hey, I'm supposed to be the dumb guy. Like he's the smart guy. I'm just the guy
you're the government employee guy. Like that's the whole, really, that's the point. It's not that you're, it's just that because we're trying to translate this stuff into ways that government employees and military, service members are going to understand it.
Yeah, maybe not dumb guy, just inexperienced or whatever. But as I've gotten more experience, I don't feel that way anymore. But what I really am is the guy that runs the podcast.
Well, that's true.
So I would just call myself the producer who sometimes just chirps in. But I'm like the guy on Joe Rogan and nobody ever sees.
Yeah,
I guarantee he gets paid way better though.
Yeah, I'm sure.
But anyway, I digress. What do you got for us this week? We say this every week, so it's becoming cliche, right? But it's been a crazy week. Yeah. Like I was out for eyeball surgery for one day, and I felt like the whole world collapsed.
It kind of did.
Yeah. So if my eyeball looks funny, that's why.
Yeah.
You have to figure out which one.
Yeah, I would hate to be in precious metals this week. Well, you loved it over the past several weeks. It was going up like a rocket ship, but things that go parabolic like that tend to fall back in the same kind of way. And we had, I don't know, actually one day this week, there was within the day a 40% decline in the price of silver. And then the next day it was up like 15% or something. And then Thursday was down 12%. I mean, it's,
so what's the silver
SLV
symbol? SLV, of course. GLD and SLV.
Yeah.
Because I was looking at that earlier. The funny thing is, before I started the podcast, we're in this, or I am now, in this, great building that we've been in for a long time. And the guy that kind of owns the building or whatever, he's usually here, and he's a big investor. And he was asking me about this as soon as I walked upstairs to get some water. And I was like, hey, what goes up must come down.
Yeah.
It has to happen at some point. You just, be happy that you were able to ride the wave.
Yeah. I mean, it's still up, a lot if you had bought it early. It's just that usually the general public, by the time it gets to the retail level, especially when things are going parabolic, you are the sucker. Like you are the person, the retail investor is the person that's holding the bag and it gets sold out from under you and you get completely screwed.
And unless you're watching it all day, every day, which we don't recommend. So here's the thing. This is what I was thinking about when the guy upstairs was asking me about this. I was like, you know what? This is why, though, we have the choices that we do in the TSP.
Yeah.
Because given the opportunity, if we had opportunities to all the ETFs in the world, there would be a lot of people that would have jumped on this bandwagon and at some point lost half their retirement.
Yeah.
I mean, because somebody would have told them at the the water fountain or whatever they call it, whatever you do now. There's no water coolers anymore. At the coffee shop, whatever. Hey, I'm all in with gold or silver. And that's great if you know what you're doing, but you could lose half your retirement if you don't. And so they are protecting us, right? The system is built in the TSP to give us broad, diversified options. And I think they do that. Now, the mutual fund window is great if you're really educated and you know what you're doing. The only thing about the mutual fund window is you have to accept that you're going to lose a lot of your return in fees and things, right? That mutual funds, by large, are way more expensive than ETFs to trade. And anyway, we're kind of digressing, but it is relevant because I know that people that are in the TSP are like always, they're watching things like, wow, where Tesla did this and the Mag 7 and gold and silver. And it's like, these are all great things to know. And I didn't used to recommend this, but I tell people, look, take like 1% of anything you could possibly invest, right? Cash wise. Go open yourself a brokerage account. Yeah, you want to do Robinhood or do whatever, go for it.
Yeah.
And do your gambling. It's no different than playing the lottery.
Yeah. I mean,
but that satisfies the urge, right?
Yeah. Satisfying that urge in TSP with your retirement account is probably not a great idea.
That's exactly what I mean. Like, go open this other account to play with this other stuff and brag about you bought, gold when it was at a bottom and do that in a different account. Don't do that in your retirement account.
Yeah. Probably not the best idea. All right. TSP Weekly Podcast, 8 February 2026. So we'll take a look at some of the economic highlights. And it's been a pretty crazy week. There are a lot of people that, are still diehard. The market's going to keep going higher. So we're going to take a look at what you would kind of think about and some of the charts you'd look at if you were a bull. And there are a lot of people that are standing by for the, some kind of major top. And we'll take a look at a couple of charts that you would look at to kind of confirm that if you're a bear. And the biggest thing really, I think from this podcast, the biggest takeaway is going to be knowing your time frame. So one of the things that's really frustrating to try to get across is if you're watching CNBC or Bloomberg and they're talking about things that are happening now, and you're trying to make reallocation decisions based on things happening now, it's not the same as if you were looking at your TSP once a week or once a month. And so we're going to kind of go through and just look at the S&P 500 from a monthly, a weekly, and a daily perspective and how you would kind of think about it. And it's really, you need to get very clear with your time frame because there are pros and cons to all three of them. And then we'll look at the TSP fund direction. So start off with a really bullish number. Manufacturing PMI jumped to 52.5. So PMI unexpectedly rose to 52.5 in January from 47.9 in December. Much better than analyst forecasts, right? The forecast was for 48.5. The readings show that economic activity in the manufacturing sector expanded in January for the first time in 12 months and the most since 2022. So we've talked about this quite a bit. There's the services sector and the manufacturing sector, and both of them together are the economy, right? The big economy, GDP. The manufacturing side gives equal weight to new orders, production, employment, supplier deliveries, and inventories. So to have a big jump is a really big deal. If you're above 50, it means the economy is expanding. We haven't seen a number above 50, right? We had this January 2025, but other than that, we haven't seen a number above 50 since 2022. So this is a huge positive for the economy right now, especially on the manufacturing side. And then services remain basically, it's high, it's 53.8. So this is the first time in a long time that both services and manufacturing are both above 50, which means they're both expanding, which is great for the economy. And it was at 53.8 for the second consecutive month. Services PMI, steady, 53.8 in January, the same as a downward revised 53.8 in December, but better than forecasts at 53.5. The reading pointed to another robust expansion in the services sector with a faster increase seen for business activity and production. So all good. So this is, again, another 3-year look. at the services PMI. And so it was the same as last month, but it's on the high side of the past 3 years. So if those two charts can keep moving higher, that's the definition of the economy growing. I mean, that's super bullish. Has nothing to do with the stock market, but it's very bullish for the economy. Okay. Initial jobless claims spiked to 231,000 from 209,000 last week. So that's a pretty good uptick. Initial jobless claims rose by 22,000 from the previous week to 231,000, sharply above market expectations of 212,000. It's the largest magnitude of initial claims in 2 months. So the rise in claims was attributed to business disruptions following the winter series of storms, prompting households to apply for unemployment benefits and maintaining the view that the U.S. labor market remains in a low firing and low hiring trend. We've talked about that quite a bit too. That is the big concern. What was it? Washington Post laid off like 2/3 of their reporters this week. There are a lot of layoffs happening, and the problem is that there's nowhere for these people to go. Okay. So initial jobless claims are up. We talked about it last week. They've been down for a while, which was good. If this line continues up, it's eventually going to get reflected in the unemployment number, which, right now is pretty low, but it's kind of the last shoe to drop, really. As long as unemployment stays low, we're not going to be in a recession. If this line starts ticking up and unemployment goes up, then we have a problem.
So I want to jump in there because I've been reading some articles about this, and this is I'm not sure this is going to be. So I'm just kind of playing devil's advocate, right? That's a lot of times we were talking about here earlier in the podcast. What role I take, and I kind of do that. Like, it's not that I disagree with that, but I was looking at particularly the Washington Post because it's one of like the 3 newspapers I read every morning, and then Amazon, which I have a lot of friends that work there, things like that. And so I've been kind of like digging under the hood, like asking questions about like, well, why, And so at least particularly, and I was going to limit this to Amazon and Washington Post because this is 2 that I kind of have some access to the back end, roughly. So the idea though is they have pumped, let's just take Washington Post because that's a good example. They had pumped so much money into people working at, and this is all newspapers, just pumping out content because you've got the online version, you've got the print version, you've got the website. When I say the online, like, there's like the paper that you subscribe to that you get. And then, so there's all this content needs to come. And what they found in the past, since like 2023, is that people just aren't reading it. Right. So there's just so much that they're like, okay, well, why are we paying you to do articles about such and such and nobody's reading it, And it was in very, strict kind of roles. And I don't want to get it wrong, but let's just say sports. Like nobody goes to the Washington Post to read about sports. They're probably going to go to Barstool or something, right? And so anyway, I thought that was kind of interesting though. But, to your point, we were talking about, well, where do they go? Like, that's true. Like, if you lost your job reporting on sport, if you're not the lead writer on the Washington Commanders, that guy or gal's probably safe.
Yeah.
Right. Yeah. But yeah, if you're just like some, web content writer for sports at Washington Post, yeah, we don't need you anymore. And so where does that person go? So that will be interesting to see how that plays out. Is that person, yeah. So I just wanted to kind of to add into that because I thought that was unique, especially, and the same thing with Amazon. They had brought on so many people during, COVID and all this thing that they were just bloated. And so if you want to save money to go buy more chips to fund AI or whatever, you fire people.
That's the concern. I mean, that's without a doubt the concern going forward is how much AI disrupts employment. And it's one thing if it disrupts employment, that's fine, as long as there are other companies that are hiring. The problem is that if there's nowhere for these people to go, that's why it said the low firing, low hiring trend. I mean, as long as the firing remains low, everything can be fine. But if the layoffs start going higher and the low hiring trend continues, there's nowhere for these people to go. That's the problem.
Yeah, it's I think it's only going to get worse, and I I think this is going to bleed over into the government too. We'll see. But if you're not learning how to use AI to make not just yourself more productive and better for whatever company or agency you work for, if you're not being that person, you're on the short list. Like, because nobody knows how to use it, and if you're the person that knows how to use it, you're going to become very, you know, uh, very productive for the company or the agency, and you're just going to be valuable. It's going to be like, well, that person's going to stay, and a lot of people are just kind of ignoring it. This is like the fourth industrial revolution.
Yeah.
If you're riding a horse and you don't think anybody's going to buy a car, you're on the wrong side.
Yeah, that's probably where we are right now, to be honest.
It 1,000%. I mean, you and I talk about this a lot because, so I was in the middle of the whole .com boom in the 90s. I'd left law enforcement and went to work at or owned part of an ISP, an internet service provider, and was in the midst of all that. Now, I didn't understand investing back then, so that kind of screwed me. I should have known more about that. But what I saw was just like, oh, this is changing everything. And everybody thought Amazon was starting a book company, and they weren't. They were starting a cloud computing company. Anyway, this is it again. We're in that kind of world where everybody's kind of poo-pooing email, and then all of a sudden it's the biggest thing. Everybody uses it. It's ubiquitous. That's AI right now, and I think it's moving any faster. But I mean, that has nothing to do with the TSP, but we're talking about economics. It could play out for government workers. And I think if you're watching this right now and you work for the federal government and you're not trying to figure out how to use AI to make yourself more productive and valuable at work, you're missing out.
Yeah, 100%. Okay. So job openings. So I think this is the last one on this. The JOLTS job opening labor turnover survey fell significantly in December, right? So that's what we're talking about, the openings. So job openings in the U.S. fell by 386,000 to 6.5 million in December, the lowest since September 2020, and well below market expectations of 7.2 million. So openings are being shrunk, right? Meanwhile, hires and total separations were little changed at 5.3 million each. Within separations, quits were unchanged, while layoffs and discharges were also little changed. But this is on the chart. It looks pretty frightening, to be honest. Obviously, the trend has been going down for a while of job openings, and it's fine again as long as unemployment doesn't tick up. But if unemployment ticks up and this job openings number stays low, there's nowhere for these people to go. All right. So let's say you're a bull. We just came off of three really monster years of gains in the C fund, and you are a bull, and you're not worried about the headlines right now, and you think the market is going to keep on going higher. So the first two are something that, whether you're a bull or a bear, is something to think about. As of February 5th, the Fear and Greed Index, right? CNN Fear and Greed Index is at 36. That is right in the middle of fear. And actually, at the end of the day, it closed at 33. So it's actually a little bit lower than that. The market does not tend to top when people are fearful, right? And a good example is silver. It was all the rage, right? Everybody's talking about silver, and it keeps going up, and the narratives are why silver should be, $200 an ounce, and it was taking over, and then it completely collapsed, right? It happened in a shorter time for silver than the .com bubble, but it was kind of similar, right? From 99 to 2000, the NASDAQ, I can't remember, went up 50% or it doubled. It went up some insane amount in the last year of that explosive blow off top, and then it completely collapsed. That's what tends to happen in major market tops. And so we're talking about a short term, right? We're talking about is the market topping like right now kind of thing. And it does not tend to top when fear and greed index is in fear or extreme fear, right? So if you're a bull, that's a positive for you. The cycles, right? We've talked about this for 3 weeks in a row, and we're probably going to keep talking about it, but we are now here, right? Somewhere in February. So this is for trend, right? It's as it says right there, a trend is more important than level. So the direction, right? In January, the market went up. It didn't go up much, but it went up. We get to the end of January, beginning of February, and we tend to cyclically have, volatility and consolidation in February. Okay. So, and strangely enough, when we get to it, hopefully Conan can remind me because I might not remember it, but we got a high, a low, a higher high, a higher low. That is the worst pattern, right? Because it creates a cone, an expanding pattern. It is the worst for investors. If you're trying to do technical analysis on an expanding triangle, it's the worst. What you have to wait for, because you have a high, a low, a higher high, so that means you're good. But now you have a lower low, so that's a problem. Then you get a higher high. So the next thing you're expecting is now another lower low to continue the pattern, right? At some point, you're going to, in this case, you got a higher low. And then once you break, up here, you're still wondering, right? Am I still in this expanding triangle pattern? Once you're up here, But even as far as here, you don't know if the market's going to reverse down and stay in that pattern. It's very, very difficult. And it's similar to what's playing out right now, which is ironic because this is the cycle chart for this year, right?
Yeah, I think this is one of the best charts right now to keep you in perspective.
Yeah, definitely.
Because it's easy to kind of look at where we are at, particularly today, in this week, and think, oh no,
Yep.
no. And you look at this and you go, well, it's kind of expected. Like at some point, we need a little churn.
Yep.
We might need a little, let a little gas off the pedal, and then it revs up again. And you just got to decide whether that fits your risk tolerance.
Right. That's the
If
most
it doesn't
important.
fit your risk tolerance, then get out.
Right. There's no guarantee that the market goes up into April. Right. This is the cycle is calling for that, but there's no guarantee that the market goes up until April and that it rolls over in April. I mean, none of this is guaranteed, right? It's like drawing with a crayon, not a, there's no guarantees to it. It gives you a guideline for what to expect this year. And so far it's been playing out pretty well. And we are now in this volatile period of February and March. So if you are a bull, you're like, okay, that's fine. I still have a few months of expected gains to go. So I'm going to weather this period of volatility and I'm going to put my head down and keep on going, right? That's if you're a bull. From a kind of under the hood perspective, this is the tech sector, okay, XLK. We know that the tech sector makes up 35 or so % of the S&P 500. A while ago, I did a chart that was a triangle. I did it on a daily chart, but that's what it would look like on the weekly. And it clearly broke that triangle to the downside. Okay. It doesn't mean that it couldn't pick up and turn into some kind of sideways consolidation, right? That's a possibility. But as it is right now, we had a serious breakdown through that triangle. So we want to see support, right? We got a peak, a brick broke above it, support there. We want to see support at that channel and have the tech sector break to the upside, and then the rally keeps going, right? Then the S&P 500 is good. And so that's what you're looking for if you're a bull. Because if we get down here, we are almost certainly to retest the prior highs down here. And that will not be good for the S&P 500. The second biggest sector in the S&P 500 is financials. And so financials have been basically going flat since the end of November, right? We got a little bit above it here, came back down and tested it again. We thought the breakout in financials was happening. That breakout failed, right? So we really want to see this support channel hold in financials, because if financials aren't going up, the S&P is not going up. Financials are a lot more of a stable core piece than tech is. Tech is a lot more volatile. Financials need to be going up for the S&P to be going up. So if you're a bull, you want support there at that support resistance channel. And then the third one is healthcare. So healthcare doesn't move as fast as financials, or certainly not as fast as tech, but it's the third biggest weighting in the S&P 500 index. And we had this ABC correction, right? Started back in late 24 and put in this bottom and came up in this 1, 2, 3, 4. So the next wave on an Elliott wave perspective should be up. And if that happens, we get above the prior high and we're good. We're good to go, right? That's what you're looking for if you're a bull. You're looking for healthcare to break out of this range to the upside. Breaks out of that range and it gets above the prior high, right? So those are the three big ones in terms of charts that I'd be looking at if I was a bull. So what if you're a bear? Okay. You think the world is falling and we're all looking for things to confirm our bias, right? That's what we do. I'd try my best to not have a bias, because I'm trying to show both sides of what you would look at from both perspectives. So now if you're a bear, what are you looking at? The blue line on these next couple of charts is always the S&P 500. The candlesticks in this case are tech divided by the S&P. So when tech is leading, when tech is moving higher, faster than the S&P, the ratio is going up and the S&P is going up. When tech is breaking down faster than the S&P is going down because tech makes up 35% of it, right? This is a huge divergence that we have right now. It looks like it's fallen off the edge of a cliff, right? So if you're bearish, you're looking at that and it's validating your bearish hypothesis. Okay. We talked about the XLK tech on the bullish side, right? We wanted the index or the ETF itself to find support at that support and resistance channel. But if the ratio has already broken below this low. So if it keeps going down, you're talking about a huge move down and it tends to lead, right? Here was the top here. Here was the top in the S&P. It was leading the S&P into that decline in April. So if you're a bull, or if you're a bear rather, you're hoping that this ratio continues down because it's going to pull the S&P 500 with it. Next one is energy, right? When tech is not doing well and the S&P is falling, energy tends to do really well. And 2022 was the best example of that, actually, because as the S&P is falling, energy is rocketing higher. Okay. So we have a big uptick in the ratio of energy versus the S&P 500. We've had them before. Well, this one was the April bottom from last year. If you're a bear, because we're talking about bears, especially this big candle that we had this week, if you're a bear, energy is exploding to the upside relative to the overall S&P, and the S&P has not really downticked that much. So it's a fear trade. People are rotating out of tech and into energy, and it just hasn't caught up to the S&P price yet. So kind of like tech, it was like the reverse of the tech chart that we just looked at. You don't want to see these jaws close like that, but that's what the implication is. And then the last one is my favorite. It's consumer staples versus the S&P. So when investors change from investing in things like Tesla and Palantir and they start buying Campbell's soup, that's not good for the S&P 500, right? So the ratio is consumer staples divided by the S&P. When when that ratio is going down, it means they're buying less consumer staples. They're buying more tech, and so the S&P is going up. When the ratio goes up, right, like 2022, it's another fear trade, right? They're buying more Campbell Soup and less Tesla, and the S&P is going down. And so this is where we are right now. I didn't do a zoomed in chart of it, but we have a double bottom. If you drew that trend line, we had the breakout this week and a huge follow through that week. I mean, that is the most frightening chart, in my opinion, right now, because people are definitely moving out of tech and into consumer staples. Now, on the one hand, if you were JC Peretz, you would say that's exactly what's supposed to happen. It's sector rotation. It's the lifeblood of the market, all that. That's why the index is staying still relatively high, because all money isn't leaving. It's rotating between sectors, right? And for now, that's fine. It's just an indication that things are not the way they are like when the market's going up here. All right. So this is probably the most important thing. Knowing your time frame. And obviously your is capitalized because you want to understand your time frame. Don't worry about what other people's time frames are. And you got to try to sift through the narratives. So if you only want to look at your TSP once a month, there are some huge positives to that. Okay. I like to use a 10-month moving average line, which is this blue line right here. Each one of these ticks is 1 month of price movement. Okay. So this is actually our long-term trend model, or a piece of it. I didn't add all the parts to it, but this is our long-term trend model. If you're a subscriber and you go to the different models that we offer, this is basically our long-term trend model. So what are the big takeaways from this, right? The model captures the big moves. So once you get back above, the way it works is you have 2 consecutive green candles, and the second green candle gets above the 10-month moving average line. That's your bullish trigger. Okay. When that happens, the market tends to move higher for a long time. I mean, we're going back here to 2016. So every time we get one of these bullish triggers, the market, again, each one of these is a month. Each tick is a month. So when you get a bullish trigger, the market tends to move higher for a long time. Okay. The bearish triggers can give you whipsaws, but you're avoiding the big drawdowns, right? Nobody knew how low 2022 was going to go, for example. But if you're following it on a monthly basis, you are out pretty close to the top from a monthly perspective, right? If you're following this model. And you're back in pretty close to the bottom. And this is on a monthly chart. I mean, that's pretty good, right? Now, you can look at this and say, okay, that's great. But each one of these ticks is a month. And so if you're looking at something like, I don't know, that's a huge percentage move to the downside before you make a decision that you're going to get out. Okay. And the market's going up and down daily and weekly throughout that month. And then finally at the end of the month, it closes below that 10-month moving average line. And that's your trigger to get out. And you look at that and go, yeah, but I had all this money in there before, and I've quote unquote lost all of it, all this money down to there. I can't get out now because, it's going to come back up. You have to understand the pros and cons of whether you're going to look at the market on a monthly, weekly, or daily basis. And where we are right now, right? We had that bullish trigger back in somewhere early in 2025, and it's been going up for, almost a year. We've been going sideways here. This was October of last year. The market's basically sideways, but last month we went out in January at all-time highs. So you're looking at this and you're looking at February and you're going, yeah, but February is a down candle. February is not even halfway through yet, right? That red candle doesn't mean anything right now. I just couldn't erase it from the chart. It may as well not exist, because until the end of the month comes, you're not looking at it. You're not making any decisions day to day or week to week. And sometimes that's a good thing. It's going to keep you in the market during the long bull periods, and it's going to keep you, it's going to minimize your downside risk.
Yeah, this model is definitely for people that have the discipline. Well, this model is for people that understand they don't have time, right, to look at this a lot. They're in the middle of the career. I don't mean the middle as far as timeline. I just mean they got a lot of work.
They got a life. Right? They have things to do.
A lot of things going on. And yet you still want to actively manage your TSP account. I think this is the best thing for you. But you have to be honest with yourself and know that you're not going to get home at night at 9 o'clock at night and check the market kind of thing. You can't do that. You have to be disciplined enough to look at it once a week. Even if you're long term, you still want to look at it once a week and make your decisions basically on a monthly basis. But you choose a week, right? It's like when you're in the short term, you're looking at weekly, but you got to choose a day to make that happen, right? In this case, you would choose a week. But I think this is the best thing in the world for people that just don't want to think about this. But most people don't have the discipline or are not honest enough with themselves to say, I'm not going to look at it. I'm not going to do it. I'm not going to stress over it. I'm going to look at it, make the decision based on, the model. And there you go. It is what it is. Because you'd fare really well, especially over a 30-year career.
Over time. Yes. In the short run, you can get clobbered in this.
Yeah.
But in the long run, I mean, I say long run, this is going back to 2016. So how long is that? I don't know, but you're in for the vast majority of the gains, and you're out when the potential was there for the market to really collapse, which obviously it did in 2022.
But it's a 30-year career.
Yep.
And it's best to be out during those massive collapse. I mean, we've seen that, right? I mean, we spent 30 years in the government. We saw a decade of, getting right back to where you were a decade before, the lost decade. Things like that actually happen. Most people just haven't witnessed it. But I do like this model. I mean, I don't particularly follow it, but because I do want to, be engaged and be more on a short-term basis. But if you really are too busy or have no inclination, this is the model for you.
Yep. Absolutely. The next shorter one, right, is a weekly version of this. And so as you would expect, there are a lot more entries and exits if you look at this on a weekly basis. But it does the same thing. In this case, each one of these ticks is 1 week of price movement. This is a 20-week moving average line in blue. So I started here at COVID. We had a huge collapse in COVID, that first big down week. And I can't remember what the percentage move was that week. It was a lot. And nobody wanted to get out because there hadn't been anything like that in so long. But there was a lot of talk about COVID and nobody knew what was going on. But that huge move down, a gap down, and then by the end of the week, you were way down here. You fell another 20% to the bottom. The whole COVID collapse was 35%. Now it came back really fast and kept on going to new highs, and that's great, right? You just get back in when it gets back above the 20-week moving average line. But there was a lot of fear here, as you all remember. And to have locked in, quote unquote, lock in my losses down here at 10 or 15% loss, whatever that week was, I don't even know. If you got back in when you got back above that line, you were even. And so you had avoided what, who knew how far that was going to go. And then once we got back above the line, you're in it for, I don't know, a year or more until we get this first big week down in 2022. And then we have this, by the end of the year, it was a 20% decline, but it was 25% to the bottom in October. Now you have these things, right? This is the problem. The shorter the time frame you get, you have whipsaws. Okay. But for the most part, when the market is moving in one direction or the other, this is a great model. And if you're looking at it once a week, and you're making weekly decisions, you're going to be in much closer you're going to get out much closer to the top and in much closer to the bottom than you would on the monthly model.
Yeah, the only reason the whipsaws are such a big deal is because we only have 2 moves a month.
Yep.
If we could move 4 or 5 times a month, this wouldn't be an issue. But that's really the only reason that doesn't. I mean, this model works extremely well if you're in an IRA or a brokerage account,
Yep.
right? The only caveat for the TSP is that we only have 2 moves, and 3 if you're wanting to go to G and or more, 3 or more. But yeah, the whipsaws, and so that's when I think, and we talk about this a lot. You have to make sure you're zooming out enough to look at the bigger trend and not get scared, by the daily movements. But I mean, both of these, the long term and the short term, this is shorter term. They both work, and this isn't just us coming up with this, right? This is a very simple kind of technical analysis, as opposed to things that other people do, right, in hedge funds and all that. But it works. But you do have to be active. You have to be actively managing it. You can't just set it and forget it.
Yeah. I fear for the people that are setting and forgetting in 2026. I really do. If you go to where we are right now, we haven't made any headway really in price. Actually, we're now below where we were in October. In general, we haven't. We've been more or less sideways on a weekly basis. Let's call it that. As long as we stay above, I mean, every time, we haven't hit that 20-week moving average line. This will be the second time since we got above it in April last year. So as long as we keep getting support at that 20-week moving average line, the market keeps going higher, right? Once we get a big candle down, that's always the indicator. You get a big candle down through that 20-week moving average line, and then the trend has most likely changed. Still no guarantees, right? You can certainly have something like this. But we're not trying to pick a top and a bottom. We're looking at probabilities and trends. And obviously, if you get down here somewhere on a candle, you have broken this trend. But we're not there yet. And then the weekly is my favorite. I mean, I spend most of my time on the weekly charts. And if you're looking at it on a daily basis, you're probably pulling your hair out. This is a 20-day moving average line in blue, and each one of the ticks is 1 day of price movement. So this was the peak in October, right? And we haven't gone anywhere since. We're above this high, which is good. Came down here and got support there. Came close right here. We're certainly close this week. But as long as on a daily basis, as long as we're above that support and resistance level, the market's basically moving sideways. If we break down here somewhere, the next low is this one. That November low is gonna, if it gets violated, it's gonna be a big deal. You're gonna hear all about it on CNBC and Bloomberg because this is an important low. But as long as we're above this channel line and we find support here, we keep on going, we put in a higher high. That's right. That's what I wanted to say. We were talking about the cycle chart and the higher high and the lower low. We put in a high right here. We came down and put in a low pretty close to that support channel. We come back, we put in a little bit of a higher high. If we put in a lower low right here, now we're in this expanding channel. We're not quite there yet, right? But if we come down to that channel, get support, and come back up, we're not going to really know we're back out of it until we get back above, say, 7,100. It's just really difficult. But in general, we're going sideways, right? All right. TSP fund direction. So we looked at this a minute ago, but this is a weekly chart. This is the one we do every week. It's a weekly chart of the S&P, the 20-week moving average line, relative strength, and MACD. So as you can kind of see, every time the market pulls back on a weekly basis, it tends to get support at that 20-week moving average line until it doesn't. And when it doesn't, that's when you have a problem. We have been above that 20-week since end of April, May of last year. We've only tested it once, and we're testing it again this week. There's no breakdown on a weekly basis yet, right? If we get a close down here somewhere, it'll certainly be a problem. If we get a close down here, it will be the first time that we're below that line. If it turned right back up the next week and kept going, great. If we're down here again, the trend has changed on a weekly basis. It's going down. On the weekly perspective, again, the November low is going to be a big deal, because if we get below that November low, you're talking about the April low. Okay. Bonds, I still think, are going to be the most important story of the year, one of anyway. And we are now in the 10th week, I think it is. 1, 2, 3, 4, 5, 6, 7, 8, 9. The 10th week where we've basically gone nowhere. It's been sideways for 10 weeks. And that's just in the short term. In the long term, it's been sideways since the middle of 2022. So can it keep going sideways for the foreseeable future? Yep, it's possible. It either goes up, down, or sideways. There's only 3 ways it can go. These coils tend to resolve pretty sharply in one direction or the other. And if the F fund breaks out sharply to the upside, it means interest rates are going down quickly. Why would interest rates go down quickly? Because the stocks are falling and the Fed is cutting rates and they're trying to get a floor under falling stock prices. That's when we use the F fund as a tool rather than the G fund. If the F fund is spiking as stocks are falling, it's a great time to be in the F fund. If the F fund goes down, right, it means rates are going up. If rates spike up in this environment, that means inflation's going up, rates are going up. What is that doing to stocks? They are not going up. So I think the F fund is really going to tell us the future once it decides which way it's going to go. All right. If you guys like that kind of analysis, definitely hit us up at growmytsp.com.
And questions. If you have any questions, make sure you put them in the comment section wherever you find this video. If you there is no comment section, you can always shoot us an email, support@growmytsp.com. We like questions. We love comments and questions. Why? Because if you're having that question, there's probably 100 or 1,000 people out there that have the same one. And so it allows us to, we'll do our best to answer it to you directly if we can, but we'll put it in the podcast and we'll talk about it because it's a topic that probably other people are interested in. So don't hesitate to put comments in the comment section wherever you find the video. If you like what you see, hey, share it with your friends. If you're not a member yet, go check out our website. We got a lot of good tools there to help you learn how to manage your TSP. As a matter of fact, our free course that you can go through to learn how to manage your TSP, you can take that course by itself and be much farther ahead on understanding how to manage your own TSP. Again, if you like it, share it with your friends. If you don't, share with them anyway. We are out of here. We'll see you next week.
Yep. Have a great week.